Hello, macro students. Welcome to Module 72 on the Federal Reserve and monetary policy. So we're focusing on this question today. How does the Federal Reserve conduct monetary policy? So we know by now that monetary policy means that the Federal Reserve would either increase the money supply or decrease the money supply, and they would do that in order to achieve some sort of an economic goal. So just like when we studied fiscal policy, if we were in a recessionary gap, they would, lower taxes or increase government spending or increase transfer payments. Well, monetary policy is another thing that can be done to get us out of a recessionary gap or an inflationary gap. So, in a recessionary gap, they would want to increase the money supply, and in an inflationary gap, they would want to decrease the money supply. But before we get into those specifics about monetary policy, let's go through these functions of the Fed. Remember, the Fed means the Federal Reserve. So that is our central bank for the United States. It is it is owned and controlled by the US federal government, but it is not like run by the president or run by Congress. It's kind of its own separate agency. All right, so we have here provide financial services. It's called the Banker's Bank. So just like I might go to like US Bank and have a bank account there, well then US Bank can go to the Federal Reserve and have an account there, which we already know that is where banks keep their reserves, right? Most of it is in an account with the Fed, and some of it is like in that vault that they have where they can keep cash. So it's the Banker's Bank. They hold reserves and they provide cash to banks. So when you know how banks will get like those brand new crispy dollars, well, it's because the Federal Reserve says that those dollars can go there. The Federal Reserve doesn't actually print the money. That is done by the U.S. Treasury, but the Federal Reserve then the money like goes to the Federal Reserve, and then the Federal Reserve will get it out to banks. All right. It is also the government's bank. So the U.S. Treasury, which is a part of the executive branch run by the president, they have an account at the Fed. So, the government has a lot of money, and so their bank account is also at the Fed, just like banks' bank accounts are at the Fed. Number 2, it says to supervise and regulate banks, make sure that banks are following all of the laws. We have already talked about what some of those laws are for banks, how they are required to keep a certain amount in reserves, right? They can't, if they get, if somebody puts money into their checking account or a checkable deposit, the bank can't take all of that money and loan it to somebody else. They have to hang on to some of it in reserves, and that they have to have, just as much in assets as they do in liabilities, and that they're not making really big risks or taking big risks with their customers' money, stuff like that. They're also in charge of maintaining stability of the financial system. So like this whole banking system, they will provide that money to banks who need it in the form of loans. And then they will also conduct monetary policy, which is changes in the money supply. And what we know is that, or what I'm about to tell you, is that changes in the money supply will change the interest rate, and changing the interest rate will therefore influence aggregate demand, and then will therefore prevent those extreme highs and lows of the economy. You know how we say smooth out the business cycle. And then we're going to add a number 5 on here, a really important number 5. So the Fed's job is also to keep prices stable. Their job is to keep prices stable. Now, what does it mean if prices are not stable? It means that prices are going up and down a lot, that price level going up and down a lot. Well, what do we call that when the price level goes up? We call that inflation. And when it goes down, we call that deflation. So what they are really trying to do is they are trying to avoid high inflation. And they try to keep inflation between like 1 to 3% a year, 1 to 3% increase a year. So if they can keep that inflation in that like 1 to 3% zone, then that is considered to be a stable spot. And that's like a really important job that the Fed has, because if we have hyperinflation, if the prices just keep going up and up and up and up at like this really rapid rate, that would be like devastating for our economy. So we really want the Fed to get that done. Okay, second page. So now we're talking about here the Fed's monetary policy tools. So how they change the money supply. And why do we have to talk about this? Because the Fed, they, if they do just like create a bunch of new money, like where's it going to go? Who's going to get it? Like, what does that even mean? And because we want our money to maintain its value, if the Fed just creates a bunch of new money and it has like nothing that backs it, like if it has like very, very little meaning behind it, then our money will get devalued, and our money, and we don't want that. We don't want our money totally devalued. All right, so there are some kind of rules that they follow in order to increase the money supply. All right, and so that these are called their monetary policy tools. All right, so this first one is the reserve requirement, also called the required reserve ratio. So if the required reserve ratio goes up, all right, so let's remind ourselves, what is the required reserve ratio? It's that percentage that banks are required to keep of their checkable deposits. So maybe we need to add that in here as a reminder. So percentage of checkable deposits banks must keep in their reserves. That's what that required reserve ratio means. The percentage of checkable deposits that banks must keep in their reserves. So if I go to the bank and I put $1,000 in my checking account, that means that the bank, if the required reserve ratio is 10%, that means that they are required to hang on to 100 of those dollars, whether that's in their vault or at their account with the Fed, and then they can loan out the other $900 to somebody else. All right, so let's say that required reserve ratio went up. If they increased the percentage from like 10% to 12%, what would that mean? Well, it would mean that banks must hold more money in their reserves. It would mean if it went up from like, let's use 10 and 20% because they're easier numbers. So if the required reserve ratio was 10% and I put $1,000 in my checking account, the bank would save $100, 10%, and loan out the other $900. And we know that the more money the banks can loan out, then the more money it can turn into, right? We talked in that other module about how money in the bank that keeps getting lent out and entering back into the banking system and then lent out again and entering back into the banking system. Remember, at 10%, it can turn $10,000 into $100,000 in our money supply. Okay, so if the required reserve ratio goes up, banks must hold more money in reserves. Therefore, banks cannot lend out as much money, and therefore the money supply goes down. Now here, let's go through the opposite. If the required reserve ratio goes down, then banks can hold less money in reserves. Therefore, they have more excess reserves to loan out. So therefore, there are more loans, and therefore the money supply increases. Money supply increases. Okay. Now let's go through like an example of that. All right, so let's stick with that 10,000. All right, so, well, okay, so we'll say that $1,000 of new money, all right, meaning like the money wasn't already in the bank anywhere. It was just like, let's say, it was found under somebody's bed somewhere. Okay, so it ended up in the banking system in checkable deposits. Okay. If required reserve ratio equals 10%, $1,000 can turn into $10,000. And how do I know that? Because of that formula. If you go $1,000 divided by 10%, which is 0.1, that equals $10,000. Okay. Now, let's say that the bank or the Fed increased the required reserve ratio. Well, let's say if they increased it to 20%, that means that $1,000 can turn into, I don't know, it would be $1,000. $1,000 divided by 0.2, which equals $5,000. So do you see here that when the required reserve ratio went from 10% to 20%, the possibilities for the money supply actually go down, right? So that $1,000 at a 10% required reserve ratio can turn into $10,000. But $1,000 at a 20% required reserve ratio can only turn into $5,000. Moving on now to what's called the discount rate. When a bank needs a loan, they can borrow money from another bank, or they can borrow money from the Federal Reserve. So the federal funds rate is the interest rate one bank will charge to another bank. Okay, so the federal funds rate is the interest rate that banks have between each other, and they can decide what that interest rate is. It's based off of the supply and demand of loans, what that equilibrium price is, and that's up to banks to decide. And the discount rate is the interest rate that the Fed will charge a bank. Now, be careful with these two terms, because one might think that the federal funds rate is the interest rate the Fed charges, but it's not. That drives me nuts, but that is what it is, okay? So make sure you keep those two straight. If the Fed lowers the discount rate to below the federal funds rate, banks will borrow money from the Fed and the money supply will go up. Okay, think about this. So if the federal funds rate, the rate that they're charging each other is 5%, and then the discount rate, they lower that to 4%. That will encourage banks to go to the Federal Reserve to borrow money instead of to another bank. Now, if a bank borrows money from another bank, what happens to the money supply? The money moves from this bank to this bank. It is entirely possible that nothing happens to the money supply, that it stays the way it is, because it's just going from one spot in the economy to a different spot in the economy. But if the bank goes to the Federal Reserve for the loan, where does that money come from? Where does the Federal Reserve get the money from? Now remember, yes, some money is paper in our pockets or in our wallets or our purses, but most money is numbers on a computer. So if a bank goes to the Federal Reserve and takes out a loan from the Federal Reserve, the Federal Reserve goes, sure, and they create money, numbers on a computer, okay? They just poof, it magically appears because they're the Federal Reserve and they can do that. And we're not the Federal Reserve, so we can't do that. Don't do that. All right? But they're the Fed. They can do that. They just this money just appears. Okay, they just create it. They literally create the money. That's what they do. Okay, and so if a bank borrows money from the Fed, that is brand new money that just got like created by the Federal Reserve. So that is like brand new money to our economy. That means that the money supply will go up. Okay. Then number 3, open market operations. All right. All right. And then it says the Fed actually uses this one. They tend not to use the other two as much. Like they don't really mess with the discount rate that much. And banks would rather borrow from each other than from the Fed because it looks bad for them to borrow from the Fed. And they don't change the required reserve ratio very often. But they do use open market, but they can if they wanted to. All right. But they do use open market operations. Now, there is something called a treasury. Now, a treasury is like a bond. So here, let's add this in. A treasury is kind of like a bond. And what it means is it equals like an IOU. You can think of it as a piece of paper that says, I owe you money, right? Like it's like a loan, right? I'll give you money. In return, I get this piece of paper that says you owe me money. Okay. So I always think of the piece of paper. Like if we were in class together right now, one of you would be standing next to me and we would be passing this piece of paper back and forth to really visualize what this means. Okay, because it takes a little bit of time. Now, again, this is a thing that I do not have memorized. I have understood. So whenever I think about this, like I can't just pop the answer off the top of my head. I pause and I think, and I usually am like, okay, where's that piece of paper going? Okay, so the piece of paper is the treasury. Okay, it is the IOU, the I owe you money, right? I owe you money. Okay. Okay. So an open market purchase. Now you have to think of this from the point of view of the Fed. Okay, point of view of the Fed. Okay, so a purchase means they're buying something, right? So a purchase means that the Fed is buying, and if they're buying something, that means in return they're giving money. Okay, so who is the Fed operating with, or like who are they exchanging with? They're exchanging with a bank. So it says here, the Fed buys a treasury bill from a bank. So if I'm the Fed, it's like, ooh, I get this piece of paper, and in return, I'm going to give that bank a bunch of money. So if the Fed just gave the bank a bunch of money, that means that the money supply increases, right? So in return, the Fed now has this IOU from the bank where the bank now owes money to the Fed, but in return, like right now though, they get to have that money and use that money. And what are they going to use that money for? Well, they're going to use it to lend, they're going to use it for loans. They're going to lend it out to people, and then it's going to start circulating in that economy and increasing our money supply. All right, so then the opposite, open market sale, right? So you're thinking from the point of view of from the Fed. The Fed is selling the thing, the treasury, and in return they get a bunch of money. So if the Fed sells a treasury bill to the bank, they're like, here you go, bank. It's $1 billion IOU, and in the return, the bank will give $1 billion to the Fed, and then that means the Fed gets the money, and the bank gets that piece of paper, and in return, like, and then what's the Fed gonna do with that money? Like, yay, the Fed gets the money, and does the Fed need to keep that money in an account? They don't. They do not need to do that because they're the Fed, and they can just create more money when they need it. So when that happens, the money supply decreases because that money disappears. Now, if sometime in the future the bank, is like, all right, y'all can have your piece of paper back and I'll take my money back, right? That could happen sometime in the future, which would then cause the money supply to increase. But at that point in time, the money supply will decrease. So those are some tools that the Fed has. Now, during the financial, sorry, my computer did something weird. During the financial crisis of 2008, the Fed got really, really involved, and they started creating some tools that weren't there, and they aren't even in our book. One of them is called quantitative easing, and if you are really interested in understanding like how the Fed got involved in helping the economy out of the 2008 financial crisis, you can definitely look that up and study it. Quantitative easing. But it's not a requirement for this class, so we don't need to go over it. All right, don't forget your summary and to turn in your notes, and I will see you soon. Bye.